You're listening to Real Investor Radio with Craig Fuhr and Jack Bevere, where we cover advanced real estate investing topics to help you stay ahead of the curve in your real estate investing business. Hey, welcome back, everyone, to Real Investor Radio. I'm Craig Fuhr, and I'm joined today not by Jack Bevere, but by a very special guest who we'll introduce wholly in a bit, but Brian Leibowitz of Dominion Properties. Sir, welcome to the podcast.
Why, thank you, Craig. I am the better looking version that you have on here.
I was going to say the hair is just kicking on both of us today. Forget that the lovely locks of Jack Bevere. We've got it all, and our craniums are huge, so we're just as smart. So we miss Jack. Jack is on a junket, I believe, in New York right now, and he will be back shortly. But dude, we were talking to Gab, our producer, prior to the show today, and I can't believe that we're actually 82 of this podcast that is solely geared towards advanced investors. We've had on, Brian, some of the most amazing guests over the last 80 plus episodes. And frankly, I'm surprised that some of these people would come on. I mean, we've talked to guys that do thousands of transactions or have done thousands of transactions who build, hundreds of houses a year against nationals, guys that do B2R, multifamily, and just I'm so proud of the content that we put forth. We were out, Brian, at the National Association of Home Builders in Vegas about a week and a half ago, 2 weeks ago. It's a huge show. So it takes up the
enormous. Yeah, I've seen it.
It takes up like 4 convention halls. We talked about it on a previous episode, but I was blown away. We're sitting in our booth and this guy comes up and he's like, "Man, I'd know that voice from anywhere."
Oh, that poor soul.
Yeah, I was like, "Holy cow, and he was like, it's must see TV for me. Like I have to listen. It's the only podcast I listen to, and
I've listened to all of them, and I share your comments, like the lineup that you guys have had over the last couple of years now. At this point, has been just impressive, and I kind of tell everybody in town that's on a more than the average investor, like, hey, you should really be listening to Jack and Craig. Like, it's just the level which you guys go into and the guests that you have on is it's just so much different than everything else that's out.
I think there's a lot of people, man, and we'll get into this in a bit, but I think there's a lot of people that probably listen to the show. They're sort of on the bubble of like scaling to the next level. I think most investors aspire to that. And what I hope people find helpful is just sort of listening to pretty average guys. We've talked to some Ivy Leaguers here on the podcast, guys that were sort of groomed to do what they're doing today. But by and large, most of the people that we've spoken to started off with a single house, and have just figured it out. Time on task, as Brenton Hess said on the last podcast, time on task, and just becoming better operators. So, man, I just want to cover a couple of things and then you and I will jump in. The 5-year Treasury note, which is something that we look at on almost constant basis here at Dominion as we write a lot of DSCR loans for investors in all 50 states. DSCR is a 30-year fixed loan. And so those loans are all indexed off of the 5-year Treasury. And that, my friend, has been coming down over the last, 3 months, kind of went up pretty high. And then has been slowly subsiding. Today, we're at 4.09%, which means, frankly, that DSCR rates are for 70 and 75% cash out right now are probably hovering somewhere in the low 7% for folks with decent credit. And I think that's been a welcomed relief as the phone appears to be ringing off the hook here at Dominion Financial with investors looking to refi or purchase turnkey rentals. So, but here's a question that I get constantly. Hey, Craig, I know where it is today, but where do you think it's going to be in the next 6 to 12 months? And if I had a crystal ball, I guess it would be just as good as yours. But I did a little research before the show today on what some of the experts in the industry, bond buyers, are saying. And so the Financial Forecast Center expects the 5-year Treasury will decrease from 4.1% in March, which it's very close to right now, to about 2.77 by October 25. Now that would be something indeed. I don't know if I'm quite as bullish.
I was going to say, that seems like a very, very meaningful drop.
Yeah, I mean, I think the deluge of investors looking to refi at that point would be, maybe like what it was a few years ago. World government bonds projects that the yield will be approximately 3.814 by the end of June. So a little bit more bearish. And frankly, if it got to that, I think we'd all be happy. Anytime it's in the threes, I think you're going to get, better money, better returns. Trading economics forecasts that the 5-year note yield will be around 4.3 at the end of the current quarter and 4.05 in the next 12 months. So not much of a change from its current level. In conjunction with all of that, the Fed had a recent meeting, decided not to change rates on the overnight. But I will say, historically, took a look back in July of 23, the Fed rate was somewhere between 5.25% to 5.5%. In September of the following year in 24, it was at 4.75 to 5. And since that time, it's come down 100 bips. What's the upside of that? Well, frankly, what we saw, Brian, was Fed comes out with a rate cut, and actually the 5-year Treasury and the 10-year all went, and the 30-year actually went up. So all of these folks that were waiting last year for Powell to make a move, which didn't happen until the third quarter, they were waiting on the sidelines, all while rates were the best we had seen in a couple of years, in the low sixes. And they're thinking, well, the Fed's going to come out, lower the overnight rate, and we will see a commensurate slide in the 5 and 10 year. That didn't happen. In fact, it was inverse. And so rates went up on the 5-year almost immediately, as well as DSCR, which again is indexed by that. And so if you're waiting for the Fed to do their thing, I would tell you that, as Jack says, you should take your wins as they come. And right now I feel like, better investors can get a decent return on, the difference between their cash flow and the 30-year, and a 30-year fixed DSCR loan. So, we're here for business. If you guys need any information, you can reach out to me at craig@thedominiongroup.com. Glad to help. So that's the 5-year Treasury. I honestly, Brian, I think I'm probably somewhere in we'll see it maybe come down into the high threes over the next 6 to 12 months. But there's a lot of glass being broken in DC right now as they're trying to reconfigure the government, which I think is a long needed thing. The tariffs are going to start kicking in on April 2nd. We don't know what that's exactly going to do to the economy. I'm hopeful that it'll bring back some manufacturing, which we'll talk about in a bit. But let's set that aside for now and get into you.
Great.
Yeah, man. So Brian Leibowitz is the Director of Acquisition and Sales, and quite frankly, disposition as well here at Dominion Financial. But you've had a long and illustrious career working almost solely with investors and investor properties. So why don't you give us your background, Brian, sort of like where you came from, how long you've been in the industry, and then we'll just kick off the conversation.
Sure. Thanks for the invite, Craig and Jack. I know you're not here, but appreciate it.
Jack did not invite you. He said that
is a valid.
You're not that guy on.
All right. So my career actually got started at Virginia Tech, go Hokies. And I met a very unique individual there named Jonathan Spinetto. I was an environmental science major. It took a little extra time to graduate. And I ended up graduating in a very awkward time of the market. I graduated in December of 2008.
Oh, yeah.
I couldn't find anything. Really genuinely could not find a job, to save my life. No one was hiring, entry-level people because, people who had 20 years experience were losing their careers, so, they were picking up talent, at entry-level jobs and stacking their employee coffers, with, people who really knew what they were doing, not lowly me. And, a good buddy of mine, Jonathan, basically reached out to me and said, hey, look, my dad runs a brokerage called Champion Homes Realty, and I need a runner. We've got all these foreclosures from Fannie Mae that we barely know what to do with because we're just inundated. So I need a runner, and I'll pay you, $15 an hour, all your gas. And when you do get an interview, take the day. So it was super easy. And I just went, man, that's great. I appreciate it. It was super helpful. And I'm always grateful, for that moment in my life because of what happened. Well, I was a runner for 4 months.
So
4
when you
months.
say runner, were
Yeah.
you going out to look at vacant homes or folks who were going into foreclosure with potential
Most,
listings there?
yeah. So these were foreclosed homes for Fannie Mae. Some of them were occupied, but like 80-90% were vacant.
Mhm.
So it wasn't, it wasn't everything occupied where you're really, really struggling to get the information that the bank is asking you to get, or Jonathan's asking you to get in that respect. But Jonathan was levered, what Fannie Mae was trying to do back then, which was they didn't know how many foreclosures they were really going to get, and they just needed people to operate and figure out how to dispo all of these foreclosures. So Fannie levered the good brokers, the good real estate agents, and allowed them to run. And that's where Jonathan came in. He had a Virginia team and a Maryland team, and I was located in Northern Virginia at the time, but I commuted all over Northern Virginia and Maryland for this role. And 4 months later, I still didn't have a job, and he is beating down my door saying, "Dude, go get your license. It's $250, right?" Like it was, and that's how it started. Like I said, "Oh man, I really want to use my degree. I just spent all this time." And damn it, Craig, I went and got my license and never looked back.
Yeah, you
And
did.
frankly, the story is fairly comical. I just don't see how anybody else was able to do it this way. Jonathan, the first day that I was licensed, literally the first day, he gave me 5 listings. Okay. And I didn't know what I was doing. Are you kidding me? Like, there's no way. Like, for those who are licensed and listening, like, you guys know the original time you got licensed, like that knowledge is so minute compared to what you're actually doing as an agent. It's just crazy. But it escalated very quickly from there because I was handling the 5 no problem. He gave me some guidance, he gave me some training. I was mentoring under our Maryland broker who was helping. And my parents had been renting and flipping homes for a while. So I had, my dad was a master plumber. So I knew real estate, right? Like I knew that, but I didn't know how to be an asset manager.
So the 5 listings that you got, were they distressed assets or were
Yeah,
they
these
just
were
typical?
these were Fannie Mae foreclosures.
Okay.
Fannie Mae foreclosures, and Jonathan had built a system behind the scenes to allow real estate agents to be a real estate agent. And then all the paperwork and all the reimbursements and all the renovations and stuff gets handled by a team behind the scenes.
So you find these houses that are basically Fannie listings, correct?
Well, they give them to you. They're assigned, they're literally a listing agreement with Fannie Mae.
I got it. And then your job at that point was then, I would think in many cases, these houses weren't always left in like pristine condition. How many of the 5 were, if you can recall, were listings where you were going out to find an investor buyer rather than a retail?
So remember, Fannie, even back then, they had a requirement where the first 10 days of it being marketed had to go to a homeowner.
Mm-hmm.
But for those in the business, we all know, like, basically 90% of those houses never belonged to go to a homeowner. They were all investor houses.
And in fact, we're talking 2008 here, where if you turned on the news on any given night, they would tell you how no one was buying houses. But during the Obama era, they did come up with quite a few incentives for new home buyers. But what we found back then, Brian, and I'm sure you can attest to this, was retail buyers did not want a house that required sweat equity. They wanted to walk in with their toothbrush and their clothes and go, "Hey, I've got my new home here." And that's quite frankly how I, cut my teeth in, like, from 2004 to 2012, was finding distressed REO properties, going in and making them the Taj Mahal, and then selling them basically for what grandmom's house next door would sell for. And even during a time where no one was buying houses, we were still selling houses in less than 30 days, all
That's
of my
right.
houses back then. So yeah, keep going.
Yeah, so those first 5, that was the first week. The second week, he gave me 10 more. And the third week, he gave me another 10. Literally in the first month, I had 20, 30 houses, and I went, whoa, 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 whoa. Okay, I'm barely hanging on, right? Like, because as an REO agent, you're doing BPOs, you're doing biweekly inspections, you're ordering all the repairs that are needed, you're maintaining it, making sure the electric's on, all the stuff, right? And I'll skip a couple steps here, man, but within the first 4 months, I had over 100 listings, and I never looked back, ever. I never thought about a what I would call a regular job, my college degree job again. And I was addicted. I was hooked. And the thing that hooked me was something similar to what Brenton was talking about in your last podcast, was just your effort directly impacts your income, period. The harder you work, the more money or the more success or the more wins you're going to get. And I was hooked, man. And it's been in me ever since.
So how long did you stay in that position? With
2 years.
With that brokerage?
2 years. Fannie restructured, and they wanted more because they were in the government limelight a little bit more in the eyes of Congress. They started aligning more with. They wanted more equality. They wanted more spread across multiple agents. So they started cutting, and they started the volume started dropping, etc. And at that point I had already 2 years in, I had sold 250 houses. Like, it was with another 100 behind. That were waiting in the wings. So this volume play was quickly dwindling, even in 08, 09, 2010, because Fannie was really trying to restructure and wanted it more fair, more even, which you got to understand at that point, like, a lot of agents just wanted in.
Yeah,
because they thought it was glory, right? Like, they thought it was.
That was an era where you found, quite an explosion in REO agents.
Yep. None of them really knew, I shouldn't say none of them, but most of them really didn't know what to expect. When you really get into the nitty gritty, you're carrying bills for 45 to 60 days. And if you've got 100 listings, that could be hundreds of thousands of dollars.
Yeah, because the agent was not only responsible for the listing, but weren't they sort of responsible for like the lawn and like making sure that the place didn't get broken into?
The utility bills, the repairs, all of it came out of the agent's, account. And then you had to be reimbursed. Fannie never put out the money themselves. And that was when you really get into where you're going to make money in the REO world, you had to be doing just massive volume to be able to lever, your talent. So that's where Jonathan really came into it. And I ended up linking up with Leo Pareja, and, Jonathan and him were close. And for those that don't know, Leo was KW's #1 agent in the world for a long time. And now he ended up switching over to EXP recently, and now he's their CEO. And these guys, these were the kings of REO at the time. Like, it was just that world of 08, 09, 2010 is just night and day difference to what we're seeing today. And the real benefit to me was the experience gained in a very short period of time, and understanding what investors were looking for, understanding the numbers, understanding the math, right? Like, that's not something that's easily learned, right? Like, for me, it was beat into my brain, over, 250 transactions. Quickly after that, once the volume started dying off, I switched over to another volume broker who had more than Fannie. Gina Gargiu is, one of the queens of Baltimore, and she still is to this day. And I respect
Legend.
Everything. I do too, and I respect her for everything that she's been able to do for effectively a 30-year career. And she started from nothing as well. And she turned her business into, God, I think today she's probably got 15 banks.
Really?
Yeah. And she's had to, and she knows this, she's had to expand how many banks she has because the volume's different.
Yeah, the transaction volume is obviously.
Exactly. But when I got there as her director of operations after the Fannie Mae stuff, she had, I think, assets on a list, with 2 or 3 banks, 4 banks type thing.
So this is like 2010-ish. Then you go to join her broker.
2012. I can't remember the specifics, but somewhere around there. And, I was there for years, and we did just crazy volumes where you're selling, 500-600 houses a year. Like, it's because these other banks didn't have the same requirements or hoops that I would say that Fannie Mae and Freddie Mac did, the quasi government, requirements. These other asset management companies would just say, hey, you know what you're doing? Here's 10, or hey, here's 50, whatever it was. And Gina was like, no, keep them coming. Because she handled her stuff. She handled the business well.
So you go to Gina's shop, and was that solely focused in like the Baltimore metro area?
Yeah, Gina's most of those transactions were because they're based off a location, your assignments. So she's right in downtown. She's in Fed Hill, and people who are listening, that's, everybody knows that's a really great spot, but it means that you get the stuff in the city, and the city is not as desirable as some of the other stuff in the county. So she never said no. And that was one of the things I respected her for. Like there was money to be made, and there were connections to link up with investors and understand who was buying what. And when you start talking about that volume, you make a lot of friends real quick.
You really do. It's
for me,
it's a big industry,
it is.
but it was very close in Baltimore, and you instantly know the players from the not and the better operators from the not.
Well, it's called Baltimore for a reason, right?
Yeah.
Like we all know each other, literally all of us. It's the player. Brenton was talking about that. There's a couple thousand people who are doing transactions. He's dead on. Like it's a joke that there's 100 of us. We all know each other.
So I was Brian sent me an email this morning. What year was that, by the way? I didn't even
2011.
So yeah, 2011. I was really, at that time I was flipping a ton of houses and in several different states, including Maryland, doing really well with the flips. But my rentals were just bringing me down like a slow Titanic. And what we found was back then was you could buy rentals in Baltimore and sort of transitional neighborhoods like most post-industrial cities for pennies on the dollar, put a significant amount of rehab in them. But man, after the downturn, it was really difficult to attract quality tenants, if you could attract them at all. And I'm in neighborhoods where it's predominantly subsidized tenants. And what we found back then was there was just better assets in better neighborhoods because there was so much stock that guys couldn't, they over rehabbed it or whatever. And the voucher tenant has this, golden ticket, and they didn't want to live in Park Heights. They didn't want to live in bombed out areas where there's a triple murder out in front of one of my apartment buildings. And so it was a great time to be a flipper, not a good time to be a landlord if you weren't solely focused on being a better operator, which frankly, that's what Fred and Jack became so good at back then.
And that's actually where I was going with that during that period where I was at Gina's, I met Jack and Fred, and
I'm sure
they were buying, very specific properties at that point. They were picking up, stuff from me, stuff from, some of the other REO agents. And, I got, I met Will, which was, who used to be at Dominion. I got to meet, all these people from Dominion. I was like, wow, what the heck is going on here? Because they operated, even at that point, they were operating at a level that was different than the other people of Baltimore. Because Jack has this very, very famous quote. And I don't know if he's ever told you, Craig, but he says that Baltimore looks very cheap on paper. But in general, it tends to chew people up and spit them out because they underestimate the turnover. The turnover is where you get crushed. And there's nothing inherently wrong with Baltimore, but people underestimate because it's not the same market as our surrounding areas or even, anything across the country. I'm sure that there are others where turnovers are very high and very, very expensive, but the housing stock, due to the age, you have to factor it in. And if you don't, you are going to get chewed up and you are going to get spit out and you're going to lose a lot because you didn't plan ahead.
Yeah, I think we've discussed that many times on the podcast. And one of the things that I don't think has come up is that, Baltimore is the same as Philly, is the same as, Trenton, New Jersey, is the same as Detroit. I could go, I'm about to go through a list on the next episode, but what is not often said is that there's so many submarkets within that small city, is, essentially. And I think what Jack and Fred became very good at with Dominion Properties was identifying the better areas. And sometimes those areas are delineated by one block.
Correct.
There's a famous map that Jack has. I don't know if he still has it on as well. It's the Baltimore topological map by neighborhood.
We still have it.
It's brilliant.
It is.
And what is striking about it is that you've got the entire city. I wish I had a link for it to suggest maybe.
It's for everybody listening. It's Baltimore City Code Map. I use it every single day.
There you go.
Every day. Okay. So, and it's a delineation of a lot of different statistics and factors across every single block. You can divide it up into neighborhoods. That's fine. but it goes block by block, sale by sale, income by income. It literally shows where there could be potential problems in a city or on a block or in a neighborhood.
Yeah. So
Very important to understand.
I think it's fair to say that most investors like Dominion aren't necessarily playing in the A markets because your return there is the price of the asset is going to be way too high to create a return.
The blue chip neighborhoods tend to be, on the upper end of where DSCR even comes close to covering. Your bread and butter tends to be, that those middle markets, the emerging, still stable. There's nothing inherently wrong with them, but the emerging markets where you've got solid home ownership and good, people who have a reasonable career, kids, they just want a safe place to live. Those places are very, very strong. And you're able to make your DSCR numbers work pretty comfortably there.
Yeah, it's funny. We talked to a couple of local portfolio guys here in Baltimore who are operating more in like the D, C, and D markets, and the theory of the case there is that if we can put out a bulletproof asset, basically one that you can go in and bang it up pretty good, but still it's going to work, and provide a really nice asset for those customers, they become less of a headache. And really that's Jack's theory, that you start to get into the C and D's markets. And again, block by block in Baltimore and a lot of cities, you start to get tenants, the headaches out of the tenants outweigh the cash flow that you're making on an asset. And to your point of turnover, the turnover in those becomes, pretty undesirable at that point.
Yeah, I recently just did a blog post on both my website and DFS's website about the Dominion standard. For those listening, Dominion literally has a standard, list of products that we put in every single rental, and it benefits both us and our tenants, because now there is a standard that they expect, that we expect, that the market expects across every single asset that we own. And frankly, people stay longer because we do choose, granite countertops, and we are choosing good LVP flooring. We're not putting in junk. We're not putting in something that's going to last one tenancy. We're going to get something like 2 or 3 tenancies out of them. And that means that if somebody does stay, our average, I think we're over 7 years now, that by the time they are reaching that 5th, 6th year with us, things still look okay. And it's just not as, there's a lot of landlords who don't think that through. And it's, they have products that are in full need of replacement within 5 years.
I agree. And we've highlighted that on the podcast several times, that the average tenancy at Dominion is about 7 years, which is,
over 7.
Over 7. Hasn't always been that way, but I think it's been that way over the last few years. And that's just better operations, better tightening your operations, really knowing your client, and then just picking better assets.
Choosing the right asset matters as well. And that's one of the things that I did want to talk with you about today, that the people who are looking at DSCR loans and looking at, building a portfolio, you really got to know your market. For us, it's, I love the fact that we have CodeMap available, because it allows me to be the expert, right? Like, I already know Baltimore better than most. We can easily say that due to my transaction volume. But when you really get into the block by block stuff, you need a tool, right? Like, you need something there to assist your knowledge base. And there are other cities that have, what's called housing market typology, HMT. There's other cities out there that have this data. And, as an investor, if you're not using that, you're losing.
You really are. It's a brilliant tool. One that when I used to speak nationwide, I would always highlight that tool and tell people, hey, if you can find this in your city, it's that beneficial. It's that great of a resource.
Most of the time, the cities have it in what they refer to as their GIS maps. So, housing market typology is what I think they're all called. They might have something, different, but it's basically a group of statistics, and they're grading each individual area based off of what those statistics represent.
All right, so
price, vacants, all sorts of stuff gets thrown in.
So we skipped ahead a little bit
We did.
from working in Gina's shop
Yeah.
to talking about Dominion. So what year did you come to Dominion Properties?
So I've been with Dominion now for coming up on 7 years. So it was August of 2018. I was part of a startup just before I came to Dominion called Remine. I was employee number 3. Jonathan Spinetto and Leo Pareja were the creators. And there's been all sorts of news about them. I've been gone from there for a long time. And, you know, that experience was interesting. Seeing how data affects our day to day was never anything that I ever thought about. But then you started combining my transaction volume with, my knowledge base with the data. And then it was a new world, just a new world. And that's where me, Jack, Fred, and the team, when I came here at 18, they weren't using a whole lot, but now we are using a lot of data behind the scenes. And I recommend everybody should be, even if it's just a property stream account, you should be levering as much as possible of AI and data that you possibly can.
So you share with me before the show, you've done over 2,500 transactions, over 700 just in the time that you've been with Dominion. What's that like, man? I mean, so it's not just, Dominion is now not just buying REO properties, right? We do a tremendous amount of marketing, which you're a part of. So what's it been like? And then we'll get into the specifics of how you acquire. What's it been like to be a part of, 700 plus transactions in such a short period of time?
Dude, I love it. It's one of those things where, the win is what I'm chasing. I love the housing, right? Like the houses themselves, because I am a realtor. I do understand, hey, there is a personal connection to a lot of these homes for people, and I get that, and I'm part of that, right? Like I get that part, but I gotta say, I love the win. I love the chase. I love, what Brenton was talking about, right? Really digging in and really finding the houses and walking houses and seeing where we can add value and feeling like we've got a leg up on somebody, on our competitors because we're going to do something better than they are because we're a better operator. That's the way we feel. Right?
Well, let's talk about that. First, I want to talk about sort of the ways in which we acquire auction, postcard, direct mail. You do a lot of TV commercials as well. By the way, Brian's only 32 years old, but look how old he looks from all the transactions he's done.
32. Add 10 to that. Jack and I are the same age.
I had no idea.
It's just funny.
So, yeah, let's talk quickly about the types of marketing that we do that you really feel is paying off. And then I want to get into the pretty stiff competition that not only we see here in Maryland, but frankly across the country. So, and how you feel you have a competitive advantage. So what are the marketing channels that we use currently to get the phone ringing with potential sellers?
Sure. So we've got like traditional marketing where we're doing, direct mail. That's a very big portion. We send out a lot of mail for very specific reasons though. And the thing that I've always wanted to delineate for most investors is you have to understand you just can't do blanket marketing. It's a waste of time. You really have to target, the people who you feel are your best, person to work with,
So are we talking letters or postcards or both there?
Mix of both. Okay. Yep, mix of both. We find that, as we've done testing over the years that, it works better in some areas. One thing works better than others, in certain areas or for the specific message. And there's times where for certain lists, because there is a touch point process where you do have to reach out to people a certain amount of times before they actually, contact us. You are doing a mix. You're doing, a handwritten letter. You're doing a postcard. You're doing a professional letter. You're doing, all sorts of stuff. And you have to know your market. You have to. Otherwise, you're just going to blow money.
So all of the above.
All of the above
on direct mail. Give us the next channel.
Next channel is our TV commercial. We've been on the local TV channel, stations for a couple years now, and there's ebbs and flows with the TV. It's part of it. The example I like to use is during the election, we couldn't compete with the ad spend, so you get kicked, and your usual 30 to 50 spots, a month goes down to 10 for the same amount of money, or 5 for the same amount of money, and you go, oh no. So, you have to understand that there is ebbs and flows, and the TV is not just for the lead sources. It's also building credibility, right?
Brand recognition.
Yeah. The brand recognition is a very big piece. And as a company, the size of Dominion, you have to be willing to understand that. You have to, really dig in and say, hey, this is a long-term play. We're going to spend the money, but the dividend that it will pay off is in, tenfold, over time.
Let me ask you this, because you and I had lunch just after I came aboard about a year or so ago, and it was actually about a year and a half ago. And I think at the time you had started doing commercials but the jury was still out on cost per lead, cost per deal, and the effectiveness of it. You appeared to be, pretty bullish on it. How long did it take for Jack, Fred, and you to really decide that, like, nah, this is something we got to stick with. This is something that's for real, no matter the cost. Well, not no matter the cost, but given the cost, this is something that we really want to stick with. How long did that take? Because I think at the time you and I spoke, like, the jury was still out.
Yeah. So one thing I will say is the cost per lead or per, contract, whichever one you want to use,
mm-hmm.
The TV is the most expensive. Just is. However,
by a factor of
2.
Okay.
Sometimes 3, depending on the lead source, right? The benefit, though, is that they are by far the most closed transaction, most closed lead. And it's because you have technically, because it's me on the commercial, right? So when I show up, they already know what I look like. They've already met me, right? They already know what I sound like. They know that we're a reputable company because we're on television.
I have to believe that some of them can't even believe that you're the guy showing up and not just some actor in a commercial.
Yeah, and it's an ongoing joke because there's, most of the time when you show up to those appointments, you get, someone, you meet a couple, right? A married couple, or, a husband and wife, or a son and a mother, whatever. One of them will smack the other one on the shoulder and say, see, I told you it was going to be the guy from TV. And, those appointments go so well. Because again, they already know you. They don't know you, but they do know you. Different than the bandit signs, where they're just calling a phone number and any Joe Schmo could show up.
How soon did, again, sitting on the fence?
That's where I was going, right?
Yeah. How soon did you realize that?
Jack said from the beginning, and I'll never forget it. Jack said, we're going to do this for a year at least. From the very beginning, the man is able to look into a crystal ball better than anybody I know.
He's very good at it.
Here we are, effectively 2 years in, and there's ebbs and flows, and he's no. There's brand recognition involved. We're still getting leads. We're not getting as many because of all sorts of factors. But bottom line, he was in it for the long haul. He knew.
It's a big, spoken to many investors who do it, and a lot who started doing it but just couldn't take the
it's a
bite.
It's 6 figures a year to stay on, front and center a full year.
Yeah,
it's hard. That's a big number. And I don't recommend it to everybody, right? Like, it's not a thing that, oh yeah, just be on TV. No, that's not how it works.
What about radio?
We tried radio and didn't get the same traction that we get with other sources. Namely, radio is way more expensive than I thought it was going to
be. It's insane. I agree.
So I think we gave that 3-4 months, 5 months, something like that, and just almost got no traction. So we ended up
getting into the weeds. Were you like AM station, FM station?
We did both. We did one on each. The two, kind of the two,
legacy stations.
Yeah, legacy stations that have real listenership. And bottom line, we didn't get anywhere. So as investors, because we are investors ourselves, we have to keep track of that. I have weekly meetings with the marketing team to understand, where's the money going? And hey, guess what? We gave it a shot. It didn't go anywhere. Plug that money into another, working lead source, and we get a lever on the stuff that is working. So that's where it was. We wanted to try it out. There are some other competitors on there, and if they're getting traction, bless them. That's great. But we just didn't get anything.
One last thing on this on the channel, tell me about how have you honed the message on the commercials, or is it largely the same since you've started? So we're on TV, and I'm assuming that you haven't used the same exact commercial for 2 years. You've probably cut a few. Do you find that some of them are more effective than others? And if so,
that's actually a really great question, Craig. What we did after the election, we switched back to our original commercial, because the newest commercial that we did, had kind of slowed down at the end of 24, and it was likely due to a number of factors, but we still wanted to throw our original one out there because it got such an impact when we first did it a few years ago. And to be honest, it's the same result. And I think that it's more linked to the market, the current state of the market, than it is the message on the television, because the messages are similar. It's me saying, hey, we'll work around your time frame, cash offer. We don't lowball anybody, which we don't. And that's a common misconception in this world. So I want to try to break down that barrier. And we do that in both commercials, but it just didn't matter. It just didn't matter. It's slower now than it was, or I'm sorry, it's as slow now as it was at in 24. From legacy data, it's going to pick up, in the next couple months. So just stay the course. Stay the course. You've been building your brand for the last 6 months. Let it happen. This is part of it.
So it's funny. I'm of this mindset that nobody watches commercials anymore, but with the baseball season coming, go Orioles.
Yeah.
I find that, I'm sitting in front of the TV watching the game. And so I'm watching the commercials. And so I see competitors of Dominion's who are also out there doing commercials. But given your knowledge of the market, how many competitors do we have in TV and radio? Do you know?
So significant? Actually, on the television itself, there are 4 real competitors in our market.
Mm-hmm.
And I respect all of them.
They're all decent
these
operators.
are all like really genuinely good operators, and I have no issue with any of them. I always make the joke that there's times where we're walking, one person's walking into an appointment, I'm walking out. We see each other, we know each other. Like again, Baltimore, we really do. There's really good operators in our area, and the ones that have been operating that well for that long, like you're gonna cross paths.
My sense is that if they're still on TV, they're probably getting similar results. Is that your experience?
No, and I have, I try to have, quarterly calls with some of these guys, just to make sure that, we're not the only ones. And, we've all kind of agreed to, let the barrier be down and just talk real. And everybody is struggling. In general, inventory is down. It just is. So, and that's a factor of the market, not because of our marketing. That's the market speaking.
Let's get into the next channel, like pay-per-click, SEO.
Auctions. Yep. We are, for those that don't know, we are heavy buyers down at the courthouse steps, the foreclosure auctions. We really know, and I really know that channel really well. And you really have to dig in to understand the math, because there's time involved, and every day that goes by, it costs you money because you're accruing interest on those, on those sales. So, with those transactions, it's heavy when it comes to the math. It takes me hours every week to underwrite this week was 14 down at the city and another, I think 4 or 5 in the county.
Auctions.
Auctions at the courthouse steps. And, there's other weeks where it's 50, and in those cases, it's multiple days of me working late nights, up early, whatever it takes to make sure that we've got a number for the people who are representing us at these.
When I was here in 2015, Jack's sole job when he would walk in the morning, he would close the door and just basically look at properties that were coming up for auction. And based on the pictures, and he became very good at it, he could kind of put a number on it. But what I think most people who want to get into purchasing at the auction steps, what they don't realize is you'll show up with 10 properties that you want to bid on, and maybe 8 of them that day got redeemed or somehow didn't make it to the steps. And so you spend a lot of time on houses that you think you're going to bid on that don't ever really actually happen. They might come up later, obviously.
Yeah.
But talk about that.
Yeah, so it's the reason why I don't do any of that underwriting until the night before. Because on that list of 50, by the time you get to, our auctions happen on usually Thursdays. So by the time you get to Wednesday afternoon, there could be 20 of them that canceled. And that's a real number, right? Like you could be down to 30, literally 2/3, of your list, just over a couple of days. So if you had done your underwriting on Monday, you wasted hours of your time. And I've got to keep, my efficiency, up to, just, highest and best use. Right. So That means, guess what? Last night I worked from, about 9 p.m. to about 1 a.m. And that's why you got that email from me, at 1 a.m. because I find that I'm able to crank out work, just like Brenton was talking about on your last podcast. It's uninterrupted. I'm able to just plow through, looking at all these photos and, because you buy them sight unseen for those who are listening. Like
It's ballsy.
yeah,
It's
and
very
it is
ballsy.
like you are taking real risk, and you have to know your market. You just do.
There's a great video still of me on YouTube, I think. I was buying houses at auction for like turnkey investors in Indianapolis. And so Indianapolis sheriff sales, they have this crazy thing where they come in, there's a whiteboard with all of the properties that are going to go. You get there at like 10 a.m.
Okay.
They've got all the properties on this whiteboard and they give you like 5 hours to go out and look at them. And there's this crazy video where we were trying to buy a mansion, like where like the Pacers live and guys like that. And we can't get in. So it was this mansion that the starting price was like $350,000. The house had to be like a $2 million house.
Yeah.
And so had to get in. So I kicked the door and it was all snowy outside. It was like hardwood floors. And dude, I just go down. I mean, assholes and elbows everywhere. So if you can find Craig Fuhr in a mansion in Indianapolis, it's still out there. But the craziness of that is that you literally, there's probably 60 properties. There was 100 guys in the room and there was 3 serious buyers. These guys are going to buy everything. But because of that, because you knew that they were that good and had such strong operations at the auctions, you had to go out and really look at these things and you really had to do the math on them. We didn't wind up buying that mansion, by the way. But yeah, man. So I remember talking to Jack on an episode several months ago where he was pretty frustrated at the auctions, not really finding a lot. What's your take these days on the competition that you see at the steps and Dominion's ability to put together a bid that makes sense, that wins?
So one, overall, it's just hard. It's just hard. And, what happens, I know it's hard. What happens every year around the holidays is auctions slow down. They always slow down. And sometimes I feel like people forget that. But I've been doing this for so long that I know that in November and December, like, hey, there's just not going to be that many auctions. And then come January, February, you get inundated where you do have 60 a week, 70 a week, whatever it is. And, there's lots of reasons behind the scenes. We don't need to go into that today. My point is that people get worried at the beginning of the year. At the end of the year, like, oh God, what's going to happen? This year, the same thing happened. However, it didn't slam us in January like it normally does. We had 1 week where it was 50 or 60. And then it's just kind of been, 30, 40, like what we would normally see. And I went, uh-oh. And that's what Jack's talking about. Like, there's just less volume. There's less inventory.
What's the competition like?
Last year when rates were, when the 5-year was, in the 3s, there'd be 40, 50 people out there,
who knew what they were doing. Like, there's a lot of guys that come to the auction that have no clue what they're doing.
Most didn't know what they were doing. The joke is that you still got the 15, 20 guys and gals who know the math better than everybody. And we're sitting in the back, right? Like, it's the noobs that are up front, who want to listen to the auctioneer, go through their cadence and, they're excited to buy, right? And that's fine, right? But I think that most people who are there underestimate what the true cost of buying one of those foreclosures really is. I mentioned it earlier, the interest is where you really get killed. In the city, it's taking somewhere in the 6 months to a year to ratify. And that whole time you're accruing interest. And some of these interest rates are 12, 15%, because it's a foreclosure interest rate. So on a $200,000 house, you've got an extra, $10, $15, $20,000 that
dude,
you didn't know.
That's crazy. I never thought of that. Such a great point. We live in, the People's Republic of Maryland, where it appears that people who haven't paid their bills have more rights than the guys who are buying the houses.
We're a redemption state. That's really what it is. And it has to go through the court system for the foreclosure to be finalized, to ratify, right? And prior to COVID, the ratifications were taking 2-3 months. And you didn't really have to factor in too much. So it wasn't as big of a deal. During COVID was bananas.
Yeah.
There was stuff, it was over a year to ratify. we're smarter than the average bear, the smarter operator. So we knew, we were like, wait a minute, that's just going to cost us way more money. So we slowed down, we factored in, my math got different, right? Like my equation of how much money we're going to need to spend in closing costs changed significantly. And so we were sitting in the background letting people buy. And sometimes that's the win down there. You don't,
Oh, yeah.
I talked about winning earlier, right? Like it's not always buying the house. Sometimes it's letting somebody else buy the house and lose.
I've said many times that a lot of winners at the auctions are actually the losers.
Correct. And look, I'm never going to disparage someone. Like their money is just as green as ours, and if they can make the numbers work, great. Like good for them. I want people to win. There's enough food on the table for all of us to eat.
Yeah, but let's keep it real. Like, look, look, maybe our margins, we want a better margin on an asset that we purchase at the auction than like, some mom and pop guy that does 5 or 10 a year. But I think by and large, we know the numbers on the purchase, the carry, and the rehab way better than most. So if some guy is outbidding you by 50 grand on a $200,000 house, he was the loser at the auction.
Correct. That I agree with. And it's the extreme that you're talking about. And I agree with you. Like the people who are outbidding me by 5 or 10 grand, hey, great, no problem. But there's times where I look at my numbers and I go, what? And it's just because somebody wasn't thinking it through. They didn't read the ad. The other one, so that the listeners know that there are trustees who don't wipe out water bills. And if you don't read the ad, like you won't know that, hey, you're going to be responsible for the outstanding water bill. And in Baltimore has some of the highest water bills per house in the US. So you need to understand, like I've seen $100,000 water bills, and like it's because somebody, the pipe burst and it ran for a month, like there's nothing you can do about that. But if you didn't read the ad to understand that you're going to be on the hook for that, you just lost your deposit because you're not closing on that house. Like you're just going to walk from your deposit and you lost, 10 grand, 20 grand, whatever you put up for your EMD. And again, you have to look at the math. You have to understand what these houses are. Also the biggest challenge for a new investor is understanding that you are responsible to get possession of these houses. So that means that you're buying them sight unseen. It could be occupied. It could be occupied legally or illegally. It could be a squatter. But either way, in the state of Maryland, you got to go to court. You can't just kick them out. Like there's no, whether they're, it's not necessarily squatters' rights, but you do have to go to court and file, very specific, court proceedings, and it costs you money, time and money, right? Like there's a piece there that people aren't thinking about.
Let's talk about the getting properties off the MRIS, like listed properties.
Yeah, the Bright MLS. Yeah.
So at the very beginning of our conversation, that was an easy time. It was shooting fish in a barrel. I could make 50 offers on a Friday, and by Monday I had 3 deals that I could go and flip. I know that it became extremely competitive, almost, to a point where it was just a waste of time. What's your take these days? I'm talking to borrowers every day across the country that are actually finding some decent deals on the MLS right now.
We are too.
And
that's my last channel, by the way, is just the straight MLS, because I shouldn't say last channel. There's, between the MLS and wholesalers, that's, you're finding stuff, but it's not the volume, right, that that the other channels provide. So they kind of get blended together in my head, that I'm getting 1 or 2 here and there a quarter type thing. But we have been finding stuff on the MLS, and Jack and I have joked, we said for years, if there's no deals on the MLS anymore, that doesn't exist. But I assure people who are listening today, there are deals. You're just not seeing. And the tool that we use is Privy. What a fantastic, affordable, easy way to review what's on the MLS. We literally get an email once in the morning, and if somebody lists something in the afternoon that also fits, we get another email in the afternoon. And me and my sales guy, like we are literally able to underwrite that in minutes, and we have an offer to them within minutes of it being listed.
Shout out to Real Investor Radio. We had Scott Fall on, who started Privy, on the podcast several months ago. So I'd highly recommend folks to go out and listen to it. We make nothing off of anybody who subscribes. Never do.
That's not anything there. I just love the product, and frankly, if you're an investor in whatever area, it doesn't matter. It links up to your MLS. So you don't need anything, right? Like you just need a privy, account, and that's it. And then you set the parameters of whatever you're looking for. That's the beauty.
It's, by the way, for folks that are listening, Brian, it's Privy was actually started for realtors
Was.
to sort of, find listings or find folks that wanted to list their houses. And somehow, I believe it was in Colorado, and somehow got the Colorado MLS to allow them to have
Shout
an
out to RE
API,
Colorado. Yeah.
that was linked to Privy, and that frankly is unheard of. They're the most closed systems ever, and due to their success, they've been able to basically replicate that with other MLSs around the country. And so what you're getting is real-time listing data.
Yes.
Not only that, but there's a plethora of other things that you get from it. Like, you can find out who bought that house and what LLC outbid you. And that, if you're a wholesaler, you can find all the great buyers in your area and then market directly to them and find out what they're looking for. And so can't speak highly enough about it. I personally have not had a chance to play with it,
I'll
but
give you my account. You can play around, like go log in, like it's fine. Like, this is what I was talking about earlier about data. Like, I think most people, it's not that they're complacent. It's that they're either scared to change what they're doing, or, hey, that's going to be a waste of money. I mean, frankly, Privy's like $1,000 a year or something like that. It is
fairly cheap,
and we've already, in the first quarter, we've already gotten 2. So by all means, let's keep going.
By the way, most MLSs for realtors, you're going to pay well over $1,000 a year for the MLS access.
Yeah, the MLSs that I used to work with when I was at Remind were, they cost the realtors hundreds, if not thousands. I mean, Bright is hundreds of dollars a year. Just is what it is. So if you can have access, not as a realtor, and you don't have full access to the MLS, but you have what you are looking for specifically, right? Like you set the parameters, you say, hey, I'm looking for items that are 60 cents on the dollar or 70 cents on the dollar, whatever it is. And it just tells you, it literally just sends you an email, which is, gone are the days of, I remember when they had Scott, when you had Scott on there, Craig, I remember when we would, do the end around, like we would search for fixer upper or,
mold.
Yeah. You would look for
investor special.
Yeah. You would look for keywords, and you're just like, oh, there's gotta be a better way. Well, here we are, 15 years later, and there is a better way.
Yeah. I used to teach my students that were all across the US. I'm like, get access to the MLS, and here are the top 30 terms that you want to do a remark search on. And the problem with that is that, you would get hits, but if you didn't understand what the values were in that neighborhood, then it was now it's a second search. Now I found that, 1212 Maple, and now I've got to do a second search on, like, is that asking price really even close to where I'm at? Like, given the fact that I'm probably going to put 50 grand into it. So I think Privy does a lot of that work for you.
Yeah, they the nice thing is that they're literally pulling comps. That's how it sends you an email. You're saying, hey, I want to look at things that are 60 cents on the dollar, or whatever you set the parameter to be. And it's literally looking within an area and finding a comp that sold for whatever that delta is. And then it says, hey, this fits your criteria, look at it. And it just, and there's times where, hey, it pulled a waterfront property. It doesn't, it's not intuitive to that point yet, but I do think that that's coming. My point is that it's very minimal that you can know immediately, like, oh, hey, that's something we need to look at further, or hey, nah, that one doesn't work. And within seconds.
So I know we only have you for an hour, and we're at an hour and 2 minutes, but I'm going to keep you anyway, because I know you're not that busy. One thing with regards to what you're seeing on the MLS, talked to several guys over the past, I would say, month, who are starting to see an uptick in short sales. Want to get your thoughts on that. And second, dude, you and I have talked about this, actually had a little campaign going for a bit, but like all of these hedge fund landlords, essentially, who went out and bought thousands of houses, I think we might be living in a time where they're starting to peel off some of these assets, because I'm seeing guys that are actually buying assets from, Invitation Homes or American Homes for Rent, whatever it is. Are you seeing that at all? So short sales and, buying from the larger hedge fund owners.
Yeah, two really good points, right? Like for those that are listening, like, Invitation Homes and, all their competitors bought thousands of houses, just
Hundreds of
thousands and
thousands.
thousands of houses for the effectively last 10 years type thing. And some of those, they are starting to peel them off. I see the transactions, but I would caution people. I think it's market by market, that they are picking and choosing which ones to dispo and which ones to keep.
Absolutely.
Because some of them are winners and many of them are losers, right? Like, it's just, they're just being strategic about what they're selling and what they're not. And I don't know if the volume is quite there yet to be able to make a statement in which I would endorse people doing a lot of marketing to them. If you want to test it out, feel free, but I don't know if it's at the stage where these hedge funds are like, oh, hey, we got to ditch or we got to bail. That's not what I'm seeing. I'm seeing them being strategic, selling off, 10.
The dogs.
Yeah, selling off 5. Oh, hey, that turnover ended up being way more than we thought. Get rid of it. That type of thing. Like, hey, we don't want to carry that anymore. So I think that's where those transactions are coming from. The short sale stuff is an interesting item. We've got basically 2 or 3 real estate agents in our, in the Baltimore region who handle, like 70-80% of these things. And they are busy. They are just very busy. And frankly, these are really good operators who understand the short sale process better than effectively everyone else. And they're my go-tos, right? Like, these are the people who we understand, like, no, like, they know they're going to get that across the finish line. Actually, one of the privy deals that we got was from a short sale agent, and Privy caught it. It understood that, hey, this thing was listed at a discount, and it was a dog. It needed a big reno, and that means that it's not in everybody's buy box.
Mm-hmm.
Dominion, luckily, we've got the capital to be able to do larger renovations like that. This is a modern home that needed, 150 grand. So, it's a lot of money for a 2010 build. I think it was.
Shout out to Rebecca Wachinski. If you were listening, love to have you as a guest on the podcast soon. Knew Rebecca back in the day when she was just sort of cutting her teeth on short sales, and now she's become.
You talk about Becca Rivera?
Yeah, her maiden name is not Rivera.
No, I know it's not. Yeah.
So yeah, she's become quite a beast at. Is it still a paperwork nightmare? Yeah.
Yep, it is. And you have to know that, right? Like, and that's why there's like 3 agents who are really, or 3 short sale agents who are really good at it.
Mm-hmm.
It's very delineated. Every bank has their own method of, of what needs to be submitted, the order it needs to be done, blah, blah, blah. So if you don't know that, you're not going to be good at doing short sales, right? But Becca is just fantastic. She's actually the one that we bought that from. So
I know,
and she's just a rock star, and her team is amazing. Like,
yeah.
I only have good things to say just because they're so good. I'm jealous of them because of how good they are, that type of thing.
Yeah, I have to say, for folks that are listening around the country, if you're not locked into the person who is the short sale wizard in your area, you should be, because I do think that the transaction for short volume is up. It's definitely a game you need to learn to play before you play it. But in any sort of even sideways downturn in the economy, I think you're going to see a lot of people in short sale situations where they're basically over leveraged on what they can get for the house if they had to fire sale the thing. And to know that person in your area who knows how to navigate the laws and the paperwork nightmare that comes with having to submit short sale offers, I think would be highly beneficial at this point.
Yeah, I agree. You really have to understand that most major metropolitan markets, there's going to be under 10 people who do the volume. So understand who they are and follow them and do the research and, make sure that you're on their list too.
Last thing for you, Brian Leibowitz, that I've always wondered, and I've never had a chance to see you do it. It's sitting across the table with, a seller who is in distress. I think it is a very delicate art. I think there's certain people that just naturally shine at it versus those who probably don't. But give us like what you've learned in sitting across the table with, like, let's say, mom just died. We've got a house that's in probate. You're going to be buying this thing, and you probably have 50 other competitors who have sent them letters, postcards, calls, all of those things. And now you're sitting across the table with them. What have you learned? Is it a set sort of presentation? Tell us about what it's like to increase your conversion rate as you sit across the table from a distressed seller.
Sure. So the first piece, this is really two things that are not negotiable. They really aren't. And the first one's empathy, and the second one is reputation. You genuinely have to empathize with what that person is going on in their life. You just have to get it. If you don't, you're not going to get. You're just not going to get that deal. It's not going to happen. The real crux of this is the stress levels of which is, that's going on with with that particular person. So daughter, son, a child who's lost a parent. I lost my dad, God, today, actually, oddly enough, today is his death anniversary. And it's just, when you think about what happened in your life, how did you feel at the time? And I'm able to go back to that moment quickly. It's a thing for me. And I'm able to empathize with those people like it's second nature to me. And there are people who just can't do that, right? Like they're very business oriented. They're very like, hey, I got to get this house. I got to make the numbers work, blah, blah, blah. Right. But there is a real connection that is made when you are able to empathize.
And genuine authenticity.
Correct. The authenticity is what matters. And that's where I was going with that. Like the being able to connect with them and understand what they are going through, because it's not always probate, right? Like it can be hey, they're behind on their bills, or they lost their job, or whatever, right? And you have to understand what is going on in their life. And if you don't, they are just going to hate you. They are just going to hate you. They're going to kick you out, and it's going to be a terrible appointment. And you wasted all that money and all that effort for nothing. And then the other piece is the reputation. Like I have, beyond Dominion, like I've done 2,500 transactions. I know how the home sale process works, and understanding what their other options are and telling them like, hey, look, I'm going to put my reputation on the line, Dominion's reputation on the line, to say like, no, I'm going to make this as easy as I possibly can because you are going through what we just connected about.
Can I stop you right there? In speaking with investors all over the country for the last 15 years of my life, and really knowing a lot of really sharp guys.
Agreed.
There was always this debate. Do you show up as like a mom and pop guy dressed in your sweater and a shirt and be that guy? Or do you show up as the big company? And frankly, I don't know how you get away from that working for Dominion. So it's always going to be sort of that thing. What's your take on that, man? Because that's been a long held debate with guys who sit across the tables from sellers.
I would say if you had asked me 15 years ago, 10 years ago, I would have said the mom and pop.
Yeah.
There has been a genuine shift to reliability because of an unstable real estate market. And having the ability to walk in and be the big guy, but still empathize, still be able to connect, right? Like, and have them understand that, we are still local, and I joke like, hey, you can come knock on our door. You want to come talk to me? Like, come knock on our door. We're on Calvert Street, downtown Baltimore. That's a thing. Like that's, or them seeing me on television, right? Mm-hmm. Like that's a thing that many other competitors can't replicate, right? Because they're operating out of a PO box. And no offense to that, but it's a different message, right? Like it's a different thing. And if you were gonna go in there and effectively tell them like, look, I know how much pain you're in right now, or I know how much stress you're in. I'm going to help you. And here's how I'm going to be able to do it. And here's my proof behind it. You can't necessarily be the mom and pop. There are some who are able to do that, and I give them a lot of credit. But now it has shifted because of it's not during COVID where houses were selling in under a week. There's pain now. There's pain to put a house on the market. It's got to be in really good condition. You have to do the renovations. It's got to be well presented. So that means you're going through lots of showings and lots of photos, and you're engaging a real estate agent, and all those fees and all that stress of people coming through your house and doing all this stuff. Like I'm able to say, hey, you're not going to do any of that, and I'm going to pay you effectively the same money that you would have paid.
Well, I think that's a similar. I don't think that's dissimilar to what others would say.
Right.
But my question, the better question is, what is a better conversion rate on an appointment? Like, Is it 1 out of 2? Is it, what is it? Like what would make you happy if you went on 10 appointments in terms of conversion?
The national average is somewhere in that 10% range.
Really?
Yeah.
I would have thought it would be a little bit higher than that.
Well, but
I
that's,
know mine was
so
higher.
that's,
So
but that's the average, right? Like, I
yeah.
think that to be successful in this business and really, really be able to maximize your ROI on your spend for marketing and how long it takes and how much money it takes to get to that person, you need to be closing 2025. That's what
Is
you
that
need.
where,
Yeah, that's what you need to be. And frankly, we went on 300 appointments last year. 300 appointments, and we got over 100 deals.
yeah.
So, we're above the average, but it's because, I'm cut from a different cloth, and so is my sales guy, right? Like we started off as real estate agents, and we know the pain that is involved with selling a house. So we're able to really connect with people, and it's a thing.
How have you, and I promise I'll let you go, over the last couple years, let's say 4 years, how have you honed that presentation? Is it really just still sort of like, yeah, I've done this a million times, or are you constantly sort of honing it to make it better? Like, man, I probably should have said this, or I should have done that. Like, give some advice to guys that are out there sitting across the table from
Yeah.
sellers.
So my piece of advice is to understand, because every municipality is going to be different with the fees that are associated or the area that you're in. There's a time frame that is involved with selling a house in a traditional manner, and it's not 30 days. Okay, it doesn't matter. Every place in the country, it is 60, 90, 100 days, sometimes more if you got to do repairs. So if some of these houses, which most of them are distressed and there's work that's needed, etc., okay, like there is a time frame that you have to understand. So the thing that I have changed over my pitch has been really hone in on the amount of money that someone is going to have to spend to get it on the market in a traditional manner.
Money and management of
Money and
contractors, which
right?
they've
Like
probably never done.
Yeah, there's paying real estate agents, doing the repairs, the closing costs, because here in Maryland they're split. Understanding those numbers off the top of your head and really being able to speak eloquently and not being like, oh, hey, I need to check with my manager and do this. Like, no. We found that leaving the offer at that moment. Okay, you've walked the house, you've taken your photos, it's taken you 30 minutes, you've had a 10-minute conversation with them about the pain, right, of what it would take to get it on the market versus our method, and then just leaving them with an offer. There is no, hey, I got to make a call, or hey, I got to do this.
We walk out to the car.
Yeah, I got to go back out to the car. Like, no. Like, you're there, professional, ready to leave an offer, and you're ready, right? Like you're ready for class. Like you've done your homework and you're ready for that test. And frankly, the positive feedback that you get from people is way worth it.
When you leave an offer, is it a contract or is it just like a? Yeah.
Nope. They get to we give people time to review. We are not pushy. There is a real pain point in people's lives where a lot of cash home buyers are pushing, right? Like they are, hey, you sign today, we can get this done, or hey, sign tomorrow, we can get this done, or they're calling them the day after, blah, blah, blah. Like we find that most people don't want that. Sure, there's people who are in a rush, right? Like that's a separate thing. But most people want to sit down, read the contract. They're not going to read it all, but they're going to skim through it. They're going to talk with their family, or they're going to talk with their attorney. They're going to do things because today most sellers are far more educated than they ever have been. They have more access to data than they ever have been. So let trust in the process and know that you are going to operate better than your competitor. And
What's your hit rate? What's your hit rate on like signing the contract on the first visit?
Oh, it's abysmal. No one signs on the first day anymore. That's not a thing.
It's crazy.
Yeah. And when I, years ago, that was the thing. Like, oh, hey, sign today, right? Like sign today, we'll get this gone. Nah, people are far more cautious, especially in a market in which we are, right? Like there's delays all over the place, and people hear horror stories about, wholesalers not closing and they get worried. Like we're able to come in and just be like, no, we're closing. You're going to have your money in 30 days or 60 days or whatever they tell us, right? hey, you need it done in 3 weeks. We'll get it done in 3 weeks. You'll have your money in your account that same day. That type of thing. There's a confidence aspect with when you link all of it together, everything that you and I have talked about today, Craig, like commercials, the mail, just the presence of Dominion in the local market, Facebook, ads, because I'm the one that's all over our Facebook stuff and I'm doing funny stuff and, and serious stuff. Like all of it comes together at that very moment that you connected with them. And now you get to say, hey, here's what I'm going to promise you we're going to do. And that is the secret sauce, right? Like it's not that secret. You just have to deliver. You have to, make good on what you're telling these people. And I think so many people in our industry don't follow through. And that's where it gets real, almost heartbreaking for some.
Yeah, we didn't even get a chance to talk about that. The amount of follow through on per lead is so staggering these days. Like guys were talking about that 10 years ago, how just can't make one call. And that's frankly the way everyone operated. Like I'm going to send out a piece of mail if I never hear back, or if I do hear back and they don't transact, like whatever, I'm just moving on. And I think that follow up, which by the way, I know we need to end here, but
okay. I got another 10 minutes easy.
All right. Well, then let's quickly talk about the amount of follow-up, amount of touches that a typical lead gets and how Dominion tracks those touches, like programmatically.
Yeah. So, obviously they get, mail if they're on our mailing list. We don't know if they've seen a commercial, right? Like unless they call in off of the specific phone number from the commercial, we won't know if they saw the commercial, right? Every now and then I'll be at an appointment or my salesperson will be at an appointment. They'll say, hey, I saw you on TV. We'll make a kind of a mental note of that. There's no real way to track that part. However, after the appointment, the amount of times that you are calling is way more than I think people understand, because most people don't transact on that first meeting anymore. They don't sign the contract that day. It takes weeks, okay, genuine weeks for them to make a decision, because they are going to shop you, which I'm fine with. I don't have any problem with that. They need to, do their homework too, and that's cool. But we're following up usually on day 5. Okay, give them some space. Day 5, day 6, day 4, whatever it is, couple days, and depending on what that conversation goes like, they'll get another touch in another 4 or 5 days, and then another touch in 2 or 3 days, and another phone call. We actually just got one under contract in 3 weeks ago, that I went on an appointment in May of 24, and I have been calling them. Okay, I did that, what I just talked about, the first 3-4 touches, the first, month and a half type thing. And then I started getting fast busy signals, and I just kept calling, man. Just kept calling. I left multiple voicemails when it would go to voicemail, and out of nowhere, I got a phone call from the daughter. Okay, the father's phone number had been disconnected, and they had gotten another piece of our mail, and it reminded them, and they sold us the house. Okay.
The amount of effort that takes, is monumental. However, the payoff is significant.
Really, I think that it's actually the talent piece of our industry today. If you're
it's just not better operators, man.
Yes, if you are not doing your follow-up, you are gonna fail. And it's so important today than it ever has been, because people don't sign on the first, on that first day, or heck, even the first week. We are fighting and scrapping and, letting people know, like, look, like we're still here. We're not going anywhere. I'm not changing my offer. Oh, hey, interest rates changed. No problem. I'm still here. That type of thing. The other thing,
by the way, mechanically, we're talking follow up via call, text, email if you have it. Yes. We're talking all channels for follow-up, right?
We rarely have their email. It's mostly a phone call or a text message. We really try to get on the phone, and there's specific talking points that you want to talk about. It's not always, you're not always leading in with oh, hey, have you made a decision? Like, no, it's about that connection again, right? Like you made all this effort for the last, that you spent all this money to get into their, at their kitchen table, make that effort and connect with them. And then the first phone call you're going to make is, hey, did you decide if you're going to go with us? No. Slow down. Okay. Talk, hey, how's it going? Have you guys found your next house yet? Have you engaged with a mover? How's your dog? Like whatever's going on in their life. We find that connection is so meaningful and so powerful that we transact further. We transact more the further we get into our follow-ups, because we are connecting with them way past the appointment. It doesn't matter. So, and there's times where they'll call me. They're being proactive now. They're like, "Hey, I haven't found a place yet. Okay, but I wanted to see if you're still interested." Of course, I'm still. Thanks for giving me a call. It's that type of relationship that you're building with that person, because they know you're going to follow through, so they want to follow through. So keep going. Like, why would you ever stop that? And even with you guys, at DFS, like, you have to do a lot of follow up. It's part of the deal, and that's the talent today. That is,
I've always said, Brian, and we can wrap it all up with a bow, that this is a business that is essentially a three-legged stool, and it's marketing, which includes acquisition and disposition. It's capital, where's your equity and where's your debt, and then finally it is contractors, right? It's really having a great team. But the problem that I think that so many investors, many who are probably listening right now, who want to get to that next stage, is like, man, I'm wearing all the hats already. I'm already staying up late at night figuring out my marketing. I'm already, I've already been on an appointment today, and I've got to go take my kids to the softball game. And to those folks that who are listening, I would encourage you that, like, this doesn't happen overnight. Brian Leibowitz didn't become a complete stud at what he does overnight, and nor did Dominion have the capacity to hire someone of Brian's caliber back in the day. Jack and Fred were wearing all of the hats. I used to follow them around to empty houses in Baltimore and make offers. And so I would just encourage everyone that it's just a time on task thing, as Brenton was saying on the last podcast. It is, where am I focusing my time to solve my issues today? And what I think you'll find is that the capital portion, if you become a better operator, and have some experience under your belt, whether it's landlord, flipping houses, multifamily, I don't care what it is, but you get a significant amount of projects that are successful under your belt, the capital is going to find you. You're going to find your equity, your cash, and you're going to, you'll call a company like Dominion to fund your debt. That problem, I believe, can be solved easily with experience. The contracting issue. If you're not out there meeting better contractors and you're flipping houses, if you don't have a funnel for hiring better contractors, I think you're really shooting yourself in the foot, because frankly, I believe that in my case, I was so lucky to be really good at finding great contractors that I worked with a guy for probably 6 years. One guy. 6, unheard of in the industry. I should have made him a partner and we'd probably still be flipping houses today. The thing that I think that most people fail to get really good at, Brian, is marketing. It's costs so much money to get the phone to ring.
Agreed.
And I know people who get phones ringing and they never pick up the phone. They don't call back. They don't have a live operator, after hours.
Hurts me.
And these are that's the easy stuff, man. That's the table stakes that, like, if you're not getting good at that, you're never going to be a great follow-up guy. You're never going to be a guy like Brian Leibowitz, who can sit across the table from someone and close 30% of your appointments. And so if you can figure out those other two legs of the stool and really get good at marketing, then I think you've got a really scalable business.
Yeah, I agree. The table stakes have changed. They just have. Like, you and Jack talk about it all the time. Jack is, I think a little bit more vocal, in the office here. Like, you have to be a rock star. You have to be. Now, you can mold yourself to be. You don't need to be born that way, right? Like, you can mold yourself into really honing in and doing the work, but it takes an immense amount of effort. I remember, Brenton was just talking about working 70-hour weeks. I still do.
Yeah.
I still do. And it's part of the deal. Like, it's never off. And until you understand that, real estate is not as passive as people want it to be. It just isn't.
So one last comment, 10 seconds.
Mm-hmm.
What are you really excited about over the next 12 months with Dominion Properties and sort of industry wide? What excites you now?
So for us, I've been working on an expansion project that we're going to move a little bit outside of the Baltimore, the greater Baltimore region. With my sales guy going on all the appointments, it's allowed me to focus a little bit further on, other things that we can do. So we've got some cool stuff coming for us, which I think is great. We have the capacity, so let's do it type thing. And then from industry wise, I really, really am hopeful that rates come down into the mid to high threes for the 5-year. I'm hoping the 10-year gets some relief as well, because if we get even a quarter point, half a point on the 10, I think the market explodes.
Yeah, I agree too.
That in true American fashion, right? Like people are just waiting for a little bit of relief, and the things that that we've been complaining about from an industry standard across the board for the last year and a half, like all goes away. And I know that that's a silver bullet, right? Like there's going to be other challenges. I get that, but I really hope for just American real estate that these home buyers get a little bit of relief. Staring down the barrel of a 6.5% mortgage, 7% mortgage, they need a little bit. They need to get in the low sixes, the high fives, and that'll change what we do, right? Like everybody will get some relief there.
Well, dude, it has been Producer Gab. I believe, frankly, this has been one of our best episodes yet. And so anytime you want to come back on the show, you big-headed, absolute brainiac machine,
Very shiny today.
Yeah. Man, it has been such a pleasure, and I can't thank you enough for doing it at the last
thanks
minute.
For the invite, Craig. I appreciate the time, dude. I'll happily come on anytime you want to riff, anytime you want to chat.
Love talking real estate with you, man. By the way, cheesesteaks soon, and we'll get up to our favorite place.
Twisting my arm.
Next.
Okay.
All right, guys. That is Real Investor Radio today.
Thanks,
with Craig Fuhr and Brian Leibowitz from the Dominion Group and Dominion Properties. You can find me on LinkedIn at Craig Fuhr, Fuhr. Reach out if you need any help or want to talk real estate. We'll talk to you soon.